Good morning, everyone. My name is Chung, and I lead the investment office as CIO at Endowus. I'm joined by my colleague Nicolas, who is a member of our investment team. In this webinar, I will be going through the review of what happened in the markets in the third quarter of this year, and Nick will be going through the third quarter performance of our key portfolios. Next page. We'll first go over our usual disclaimer for Singapore. Next page. As you know, Endowus is a digital wealth platform that seeks to help investors through conflict-free advice, institutional access, and low fees. Next page. While Endowus employees still own the most shares in our company, we're backed by well-recognized strategic and venture shareholders such as UBS, Citi Ventures, and Prosus, with the most recent fundraising round led by Illuminate Financial. Next page. Now turning to the third quarter market review. Next page. In the third quarter, markets continue to be risk on, with the Fed cutting rates by 25 basis points in September. This was something that was fairly well expected and telegraphed even before the FOMC meeting itself, and this helped the equity markets move higher, as market viewed this as a looser monetary policy amid weakening but not recessionary economic conditions. The market was also supported by the continued optimism around AI as the hyperscalers released plans to invest heavily into this sector. Global equity markets rallied 7.6% on a US dollar basis and 8.9% on an SGD basis in the third quarter alone. So it was a very strong quarter. It was interesting, however, that even with risk assets moving higher and with high quality stocks underperforming low quality stocks substantially, gold, which is normally considered a safe haven asset, rallied 16.8% during the quarter. Next page. As you can see in this chart, equities rallied significantly since the April Liberation Day sell-off and well into the third quarter, while commodities also rose by 4.9%. Despite the weakness in the crude oils, thanks to the strength in gold. I think we're taking a bit of time to go to the next page. Here's the next page. On rates, the US Treasury experienced what we call a bull steepening, which means the overall rates went lower, but the short end of the curve went down more than the longer end. And on the credit spread side, both the investment grade and high yield spreads have tightened even further from an already low level as the risk on environment continues. Next page. So I'm sure a lot of you have seen this chart quite a few times, but when we look at our usual performance quilt chart, the first thing you should notice is how colorful and unexpected the patterns are. And this shows how difficult it is to predict the best performer for the next quarter or the next year. The second thing is that in 2025, non-US equities have been doing very well. So China equities, Korean equities, and Japanese equities top the charts. So while US equities were also pretty strong in the third quarter, with mega tech leading the charge, Asia and EM equities showed why it is a good diversifier away from the US. Next page. And from a sector perspective, 9 out of the 10 sectors showed positive performance, with consumer defensives the only negative performer. Cyclicals overall outperformed defensives, with the materials sector, particularly gold miners, leading the charge. Next page. So in fixed income, bonds overall showed solid performance on a local currency basis as the rates moved lower and spreads tightened. However, just like equities, EM debt outperformed the rest of the pack. Next page. So on rate expectations, both the Fed dot plots and market forecasts are expecting cuts, with the market expecting more rate cuts near term. Now, At the time of this recording, which is October 30th morning, just last night, the Fed cut another 25 basis points as broadly expected. Going forward, however, as we have seen time and time again, forecasting rates are very difficult, and very often the market estimates should be for reference only. Next page. So looking at the last page of this market review, before I hand it over to Nick, we see in this chart that historically there have been a wide range of outcomes following the first rate cut, and in this case, another rate cut last night. However, absent a recession, the equity market actually tends to do pretty well. So during recessions, however, like you see in the bottom green dots during the 1989 recession, the dot-com bust, and the global financial crisis, the market does poorly. So it is really dependent on whether there is a recession following or not. And in this particular case, the market seems to be telling us that the recession probabilities are fairly low. As for other asset classes, gold tends to do well during rate cuts, as you can see here, while USD is mixed. However, as the rally in gold over the last few years was much less a result of rates moving lower, but more because of central banks buying the historical playbook. More because of central banks buying gold up, the historical playbook may not be applicable in this particular case. Overall, we view third quarter to have been a strong market for investing, but it continues to teach us that the lesson that diversification is the only free lunch is still very valid and is very, very hard to forecast the markets. So with that, I would like to hand it over to my colleague Nick to cover the performance of our portfolios.
Thank you, Hugh. Hi everyone, I'm Nicolas, Investment Associate at Endowus. I'll be walking us through a review of our Endowus portfolio's Q3 2025 performance. Next page. So starting with our flagship and cash SRS portfolios, we saw good relative performance in Q3. Now on the back of the strong rally in global equities, the flagship 100% equities portfolio delivered 9.5% in Q3, outperforming the global equities benchmark, which delivered 8.9% over the same period. The portfolio's overweight to emerging market equities contributed to the outperformance, as emerging market equities outperformed their developed market counterparts over the quarter. As for the flagship 100% fixed income portfolio, on the back of falling US Treasury yields and tighter credit spreads, the portfolio delivered 1.7% in Q3, outperforming the broader fixed income market, which delivered 0.5%. The outperformance was mainly driven by the portfolio's overweight to emerging market bonds. And emerging market bonds experienced robust performance on the back of the Fed's rate cut in September, as well as an improving economic fundamentals of emerging market countries. Now within the portfolio, all fixed income funds delivered positive returns and outperformed the global fixed income benchmark, except the Amundi Index Global Aggregate Fund, which passively tracks the benchmark. Next page. Moving on to our flagship CPF portfolios. Similarly, we see that flagship CPF portfolios delivered good relative performance in Q3. The flagship CPF 100% equities portfolio delivered 9.6% returns in Q3, outperforming the global equities benchmark, which generated 8.9%. The outperformance was driven by the portfolio's overweight to emerging market equities, which performed well relative to developed market equities. As for the flagship CPF 100% fixed income portfolio, it returned 1% in Q3, outperforming the broader global fixed income market, which delivered 0.5%. The portfolio's outperformance was driven by its overweight to Singapore bonds, mainly via the Eastspring Singapore Select Bond Fund, which is also the best performing fund within the portfolio this quarter. And within the portfolio, all fixed income funds delivered positive returns and outperformed the global fixed income benchmark, except the Amundi Global Aggregate Fund, which passively tracks the index. Next page, please. For income portfolios, the stable income portfolio, which is a 100% fixed income portfolio, delivered 1.5% in Q3, slightly outperforming the broader credit market, which delivered 1.4%. The portfolio benefited from its allocation to emerging market bonds and Asian bonds, as both these areas continued to deliver strong returns in Q3 on the back of improved sentiment towards China. For the higher income portfolio, which has 80% fixed income and 20% equities, the portfolio gained 2.3% in Q3, underperforming the 2080 benchmark, which delivered 2.9%. The portfolio's fixed income component outperformed the broader fixed income market due to its allocation to emerging market and Asian bonds, as well as its allocation to the high-yield market. However, the equity component of the portfolio underperformed the broader equities market as currency hedging by most of the underlying funds weighed on performance as US dollar appreciated against the Sing dollar in Q3. Additionally, the portfolio's allocation and security selection in the real estate sector was another main detractor. Now, for the future income portfolio, which has 60% fixed income and 40% equities, it delivered 3.4% in Q3. However, it underperformed the 40-60 benchmark, which delivered 4.4%. The portfolio's underperformance was driven by its equity component, specifically allocation to low volatility stocks via the AB Low Volatility Equity Fund weighed on relative performance, as low volatility stocks struggled in a risk-on Q3. The portfolio's overweight to European equities also weighed on performance. In terms of payouts, the recent increase in hedging costs between Sing dollar and US dollar has led certain fund managers to lower their funds payout, impacting the overall payout levels across all income portfolios. Specifically, this has caused the higher income portfolio's payout yield to dip below the existing target payout range. As a result, we are revising the target payout of the higher income portfolio downward from the 5.5 to 6.5% range to 5 to 6% range. While the higher income portfolio has more higher allocation and stable income, we are comfortable with higher income generating a similar payout level to that of stable income, given that high-yield spreads are particularly tight now. Stable income and future income portfolios continue to meet their payout targets of 5 to 6% and 3 to 4.5% respectively. We are continuously monitoring the portfolios and current interest rate levels and will adjust the target payout levels accordingly if deemed necessary, as well as improve the portfolios if we believe there are better building blocks available. Next page, please. For ESG portfolios, the ESG 100% equity portfolio delivered 5.8% in Q3, but underperformed the global equity market, which returned 8.9%. The portfolio's tilt to small cap and quality style stocks in emerging markets weighed on relative performance, as both lagged the broader emerging market meaningfully. Additionally, the portfolio's allocation to sustainable infrastructure also weighed on relative performance in Q3. As for the ESG 100% fixed income portfolio, the portfolio delivered 1.5% in Q3, outperforming the broader fixed income market. The portfolio's allocation to Asian bonds, as well as its overweight exposure to credit, which benefited from credit spreads tightening, drove outperformance during the quarter. Now, within the portfolio, all of the underlying funds outperformed the benchmark during the quarter. Next page, please. Moving on to our factors portfolio. The factors 100% equities portfolio ended Q3 up 9.1%, beating the equities benchmark. The portfolio's outperformance stemmed from its overweight to emerging market equities, which saw robust performance. For the factors 100% fixed income portfolio, the portfolio ended the quarter up 0.9%, outperforming the broader fixed income market, which delivered 0.5%. Within the portfolio, all the underlying fixed income funds outperformed the benchmark, and specifically, the Dimensional Global Fixed Income Fund was the best performing fund and drove portfolio's outperformance, as its longer duration and higher credit exposure benefited from the Fed's interest rate cuts, as well as the tightening of credit spreads. Next page, please. Moving on to our satellite portfolios. The China equities portfolio delivered a staggering 19.2% in Q3, but underperformed its China equities benchmark, which delivered 21.5%. China's equity market saw a sharp rebound in Q3 on the back of policy support for domestic chipmakers and an increasing AI spend and product rollout by China's big tech companies. Within the portfolio, the UBS Investment A China Opportunities Fund was the weakest performer, and it weighed on the portfolio's relative performance. Moving on to the real assets portfolio, which ended the quarter up 4%. All underlying funds contributed positively to returns, with the 91 Global Natural Resources Fund ending the quarter up 12.2%. The fund benefited from the strength of gold, with its returns driven by its holdings in gold and silver mining companies. For the Mega Trends portfolio, the portfolio delivered 8.2% in Q3, but underperformed the benchmark, which generated 8.9%. The portfolio's performance was mainly supported by single-theme funds, such as the GMO Climate Change Fund and the Janus Henderson Horizon Biotech Fund, as their respective themes did well during the quarter. However, the portfolio's performance was put down by the DWS Global Agribusiness Fund, which was the only negative performer in Q3, due to poor sentiment around the agriculture sector. As for the tech portfolio, it ended Q3 up 10.1%. While performance was robust, it trailed behind the Morningstar Global Tech Index, which returned 13.3% within the quarter. The main detractors were the Franklin Technology Fund and the BGF World Technology Fund, which underperformed as they were underweight tech hardware and peripherals. Next slide, please. Last but not least, our cash smart portfolios. All three cash smart portfolios continued to deliver positive returns in Q3 and performed according to their risk levels, with Cash Smart Secure being the lowest risk, followed by Cash Smart Enhanced, and then Cash Smart Ultra, which has the highest risk. Cash Smart Secure delivered 0.5% in Q3, and its two underlying funds, the Fullerton Sing Dollar Cash Fund and the Lion Global Sing Dollar Enhanced Liquidity Fund, responded positively to the falling Singapore rate environment and contributed positive returns consistently across the quarter. As for Cash Smart Enhanced, it ended the quarter up 0.8%. Similarly, all underlying funds contributed positively in Q3, with the portfolio benefiting more from its higher duration and credit exposure via the UOB United Sing Dollar Fund, which ended the quarter up 1.1%. CashSmart Ultra generated 1.1% in Q3, contributing the strongest return among the CashSmart portfolios. All underlying funds generated positive returns, with the short duration bond funds leading the charge. A combination of lower yields and tighter spreads provided favorable tailwinds for short duration bonds, which CashSmart Ultra has the highest allocation to, and therefore performed the best in Q3 among the three CashSmart portfolios. Next slide, please. And with that, we have come to the end of our Q3 portfolio performance webinar. We also have a written article on our Q3 portfolio performance, which you can find on our website, and it goes into a bit more detail on how our portfolio performed during the quarter. We hope that you have found the content we discussed today insightful, and do feel free to reach out to our client advisors should you have any questions. Thank you.
Thank you.